Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data. Right now, retail investors are completely missing the largest structural shift in the history of digital finance. Top-tier consulting firms, specifically Boston Consulting Group and McKinsey, have officially projected the tokenized real-world asset market to reach $27 trillion by the year 2030. While retail stares at stagnant charts, the largest institutions on Wall Street are positioning for a massive capital rotation. Ripple has just been quietly placed on an institutional unicorn index alongside entities like SpaceX and OpenAI. This gives them an implied valuation of up to $50 billion based purely on internal share buybacks. But stay with this analysis until the end, because the numbers happening beneath the surface point to a specific mathematically inevitable liquidity repricing event. The psychological game operating in the market today is designed entirely to break your conviction. 99% of retail investors are currently paralyzed, staring blankly at the Bitcoin price in the Fear and Greed Index. They are looking for a breakout candle that is simply not coming on their timeline. This is what we call the wrong ruler trap. You cannot measure an institutional settlement bridge using standard retail charting tools. When the price stays flat for months, retail automatically assumes the project has failed. They do not realize that quiet markets are exactly where smart money accumulates. Large US institutions are quietly setting up the infrastructure to replace a deeply outdated $150 trillion SWIFT system. They are using your boredom to extract your assets at a heavy discount. Holding your position right now is the most logical defense against this engineered retail capitulation. Wall Street does not care about retail fear of missing out, nor do they care about social media sentiment. They only care about the structural demand generated by a global settlement transition. Smart money wants you to surrender your holdings before the real volume arrives. You must validate your decision to hold by looking at the actual data rather than the daily price fluctuations. The flat public price is simply a facade, a carefully managed holding pattern, while the actual plumbing of the new financial system is connected in the background. Your physical assets are the exact units of liquidity they need to operate their upcoming corridors. Relinquishing them now means handing over your leverage just before the institutional floodgates open. We are currently tracking a massive, sustained supply compression that the public order books are completely hiding. There has been a continuous and massive outflow of tokens from centralized exchanges starting in early May. Many assume this is simply retail moving their bags to cold storage, but the data proves otherwise. It is verified, large-scale over-the-counter absorption. US institutional entities are aggressively acquiring the asset outside of public order books. They are doing this specifically to prevent triggering a premature price spike that would ruin their accumulation averages. They are draining the visible supply, pulling it into deep, highly secure custody solutions. This silent extraction creates a baseline structural floor that will eventually force the public market to reprice the asset. The math simply does not allow for infinite institutional buying without a violent market correction. The entities executing this accumulation are not buying to trade for small margins. Institutions establishing new on-demand liquidity corridors are hoarding the asset as permanent working capital. They absolutely require this specific fixed function capital to run their cross-border settlement engines without interruption. When a token is absorbed into an institutional corridor, it is systematically and permanently removed from the tradable float. It stops being a speculative trading instrument and becomes a localized utility mechanism. This level of constant demand absorption shrinks the available supply on a daily basis. Wall Street cannot build a global, frictionless payment network if they do not hold the underlying bridge asset in massive quantities. They are securing their working capital today, ensuring they are fully funded when the US regulatory environment officially permits widespread institutional scaling. The true scale of this demand becomes apparent when you analyze the sheer volume of legacy banking operations. JP Morgan currently processes $6 trillion in wholesale volume every single day. To process even a tiny fraction of that daily volume without facing massive delays or exorbitant fees, a zero-slippage bridge asset is mathematically required. The current legacy systems are too slow and hold too much friction, creating severe liquidity constraints for modern institutional scaling. By transitioning to a decentralized ledger, these banks can eliminate the need for pre-funded offshore accounts. They can free up trillions in dormant capital. The math is highly transparent to anyone willing to look at the enterprise settlement requirements. A $27 trillion real-world asset market cannot run on an infrastructure that takes 3 days to settle a single cross-border transaction. This foundational shift explains the massive $45 billion valuation that Ripple just received on the Institutional Unicorn Index. The largest US capital allocators are pricing the company as foundational next-generation infrastructure. This valuation is completely disconnected from retail crypto sentiment or daily token trading volumes. Private equity firms and sovereign wealth managers do not allocate capital based on retail hype. They allocate based on verified revenue models and structural market dominance. Ripple is being valued alongside aerospace pioneers and artificial intelligence leaders because they are building the central nervous system for institutional finance. While retail traders argue over fractions of a penny, the smartest money in the United States is quietly valuing the underlying architecture at $50 billion. This severe disconnect between private valuation and public token price is a calculated anomaly. David Schwartz recently revealed a profound technical distinction known as the two-layer thesis, which permanently separates this asset from the rest of the market. He confirmed a foundational reality that retail refuses to accept. Bitcoin is merely a neutral liquidity asset with absolutely zero on-chain decentralized finance. It is simply a legacy store of value that sits idle in institutional wallets. In stark contrast, the ledger operates simultaneously on two distinct layers. It functions as a global liquidity asset, but it also serves as the actual financial infrastructure actively being deployed by massive entities like the DTCC and MasterCard. Measuring an active two-layer institutional settlement bridge against an idle store of value is a fundamental error. They are not competitors and they do not share the same target market or utility mechanics. Retail also deeply misunderstands the concept of on-chain volume due to a flawed perspective on how value is actually stored. Think of the US dollar paper analogy. The true value of the dollar does not lie in the physical paper bills changing hands at a local store. Its true power lies in global derivatives, sovereign contracts, and foreign reserves. Similarly, the asset's value ecosystem is compounding massively off-chain. It is growing through heavily regulated exchange-traded funds, deep institutional custody arrangements, and upcoming wrapper products. The visible on-chain volume is just the anchor, while the real financial weight exists in the institutional derivatives and secondary markets built around it. Ignoring this off-chain expansion is like evaluating the entire United States economy by only counting the physical cash inside a single retail bank branch. The ecosystem is expanding rapidly, proving that real-world utility is growing regardless of the stagnant daily price. BlackRock has already launched its BUIDL tokenized money market fund on public infrastructure, signaling a massive shift in asset management. To move value between these massive US tokenized asset ecosystems seamlessly, a highly compliant zero-slippage bridge is strictly necessary. Ripple's stablecoin product is actively being positioned to fill this exact role. This integration forms the backbone of the $27 trillion real-world asset market we discussed earlier. BlackRock and JP Morgan are not building these tokenized systems as a theoretical experiment. They are deploying live capital, and they require a neutral, efficient ledger to route that capital globally. The infrastructure is being locked into place right now, quietly and efficiently, while the public remains entirely distracted. The final piece of this calculated institutional setup is the rapidly closing regulatory catalyst window. The Genius Act has already passed, providing the initial legal permission slip for heavy institutional stablecoin deployment. Now, the upcoming Senate Banking Committee markup for the Clarity Act represents the ultimate legislative trigger. That markup will legally unleash stockpiled US institutional capital directly onto the ledger. The over-the-counter absorption, the unicorn valuation, the two-layer infrastructure, and the BlackRock integrations are all converging on this specific regulatory deadline. The smart money is already positioned for the impending liquidity repricing event. You have the data, you understand the hidden math, and you know exactly why the supply is shrinking. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.